Hello and welcome to Any Answers Answered for November 2022. An interesting time in the world of tax, but all of the political side of things we're leaving to Tax TV this month. Do join us for that if you would like to. But we will answer, as ever, 2 questions from the pages of Any Answers. And our first question, Tim, comes from AJ Adams. And AJ Adams has a question on brought forward trading losses. Now, of course, we will be political. Ever since George Osborne changed those rules a few years ago, we've had some interesting conversations in this area. Now, AJ Adams says, appreciate you have to offset current year losses. Okay, they have a brought forward loss post 2017, and they'd like to set that against a current year company chargeable gain. AJ Adams says, I appreciate you have to offset current year losses first. Not sure you do. But could you carry back the losses against a year in which you had made a chargeable gain? There's a few questions hidden within that, actually, Tim, so I'm simply going to hand over to you and ask the fundamental one. If I carry forwards a loss, can I set it against a future chargeable gain?
Simple answer, yes. And what drew our attention to this particular Any Answers question was that as of the time of recording this, there were no postings whatsoever attempting to answer the question. So I thought, well, I wonder why that is, because it's not an unusual scenario, and you would have thought that the post-17 corporation tax loss regime would be of interest to AccountingWEB subscribers. Well, it is quite complicated. And first, the rules relating to losses arising before George Osborne changed the rules in April 17 were simply that a brought forward loss could only be offset against future trading profits from the very same trade. But he relaxed that rule dramatically, and we can now carry forward post-April 17 losses in a company and set them against any profits of the company in a later accounting period. But it's even better than that, because as with group relief, the offset of the brought forward loss is flexible. You don't have to use all of it, so you could decide just to use some of the brought forward loss. And that's going to be particularly important next year if the current Chancellor continues with the idea of increasing corporation tax to 25%, because that's going to give a marginal rate for profits between 50 and 250,000 of 26.5%, and it will be advantageous for companies to use losses if they can reduce the profits to just 50,000 and get relief at 26.5% instead of reducing it further and only getting relief at 19%. Or using it earlier. So that flexibility is going to be very useful, but it contrasts with the lack of flexibility for current year and carry back rather than carry forward. And the old rules continue to apply. If you've got a trading loss in the current period, you can offset it against total profits of the same accounting period or the previous one, assuming a 12-month period, but although there's flexibility as to which of those you do, you don't have to do them both. You do have to claim the full amount of loss available against the full amount of profits available. You don't have the same flexibility. So that makes the whole question of optimal use of corporate losses far more interesting. And the question raised by the original poster can be answered by saying, yes, you can carry forward and set against chargeable gains. However, that isn't necessarily going to do what you're hoping to achieve in terms of carrying back a loss. We'll need to look at what the current year loss position is, and you could carry back a loss once we're looking at the post-April 17 regime, while at the same time carrying forward another loss, but I'm not quite sure why you would want to.
And of course, in a desperate attempt by Mr. Sunak to try and persuade people to use their losses early rather than carrying them forwards and benefit, as you're saying, at 25% or 26.5%, he introduced that extended carryback of £2 million. And his goal there was to encourage people to use the loss before we ever got to a 26% situation.
In my answer, I've totally ignored the temporary extension because of the pandemic, which does add a further factor to the complication of these corporation tax loss claims.
But certainly 25 at 26.5 even a very, very attractive proposition. Our second question is from Snickers in a Twix, and it's about cars and LLPs. Now, the question here is, they've taken over a new client, and the client is extremely concerned because the P11Ds for the partners haven't been filed. I mean, I'm almost tempted to stop at that point and say there's a problem here. Snickers says, we have copies of the P11Ds, which they believe need to be filed into trading LLP, and the question from Snickers is, surely partner cars are just dealt with in a normal partner way. They're not salaried partners, they specify, and therefore why would this create a P11D situation? I mean, technically we should, I guess, talk about members rather than partners for this LLP, but I'd have thought this just doesn't create a problem at all, does it?
Well, there does seem to be a significant misunderstanding at the root of this, and the poster of the question is quite right to cast doubt on the previous agent's treatment of the members of the LLP as if they were what we might call salaried partners, i.e. employees. And of course, for years, the large firms of accountants and some smaller ones constituted under the Partnership Act 1890, before LLPs were brought into being, would have a sort of intermediate stage between senior manager, if you like, and full equity partner, and they would call somebody a partner, but they'd simply be entitled to their salary and not subject to the partnership agreement, not an equity interest partner, and they were still under PAYE and subject to P11Ds on benefits. But here we're clearly looking at members of an LLP, and they, unless they're corporate members of course, individual members of an LLP, unless there is some clear evidence to the contrary, are self-employed in just the same way as you and I are as partners in the professional training partnership. And so the tax treatment of their cars will be on the basis of self-employed individuals, not employees. So there are no P11Ds to be submitted. Interesting to know what to do about the earlier years when they were submitted. And one of the posters, interestingly, refers to a case that you and I talked about a year or so ago involving a Mr. Wilson, I think an international tax expert, who was a partner, a member of an LLP, but who sought to argue that he should be treated as an employee, and he wanted the partnership to pay his national insurance contributions. Well, he lost that case. The evidence was that he was subject to the partnership agreement and was therefore not an employee. Now, that was to do with national insurance rather than P11D benefits, but it does highlight the point that I've made about the members of the LLP being subject to self-employment tax rules, not employee tax and benefit rules.
It really is an awful lot to think about. And I mean, the Wilson case, of course, was odd in itself in that we knew this area of tax would end up being questioned, but we had assumed it would be people wanting to prove they were self-employed rather than employed. And in fact, Wilson wanted to demonstrate the other way around. He wanted to be viewed as a salaried partner rather than a full equity partner for various national insurance reasons. We had anticipated it being the other way around, but it is an area of great confusion, as demonstrated beautifully by that particular question from Snickers in a Twix. That's all for this time. Do keep posting your questions, and perhaps next time it'll be your question that we have a look at. For today, bye-bye.